In this week's video, we'll address the million-dollar question: how meaningful was Friday's big rally in stocks? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Regular clients and viewers may remember in 2015 we said that if we continued to execute consistently and faithfully, eventually when a trend emerged, good things would start to happen. The purpose of showing these numbers is basically for one reason and one reason only: to show that the model can add value when a trend does emerge. We've had a trend emerge recently. It's been a downtrend as of Thursday's close on 2/11, just looking at one account that makes all of the trades and allocates just as the model would, down 1.7% year to date. As of the same period year to date, the S&P 500 index was down 10.5%, meaning the model is beating the S&P 500 by 8.8% year to date. And obviously we had some give back on Friday and that gap closed. It's still a significant gap. And also, when you're exploiting a trend via the model, you're always going to have periods of give back and then gains, give back, gains, give back, gains. So Friday's session doesn't necessarily mean anything's changed. We may be in a situation like this where we give some back and then gain it back, and obviously that is to be determined. Some other things that we can learn from this year-to-date performance: it would be one thing to be outperforming the S&P 500 by 8.8% year-to-date if you were in a conservative stance during calendar year 2015, but clients know that in the spring of 2015, we basically had a full allocation to stocks, and then we even allocated back to stocks late in the year. It shows that the model can migrate to a proper allocation. It just needs a trend to emerge and have a trend last for some period. Going forward, it doesn't really matter to us if the trend remains down or if Friday was a bottom and we're going to start a new uptrend. If that is the case, the evidence will improve, just as the evidence began to deteriorate in early December. The last time the model made a growth-oriented move was early December. Since then, it's been doing nothing but cutting and adding conservative assets. Also, you can make the argument that you're still down year to date, but the objective in the early stages of a bear market or correction is to lose less than the S&P 500. If this is indeed a bear market, eventually this number will flip positive because we've migrated properly. The same thing can be said in the other direction. If a bottom is in place and we rally for 3 months, 3 weeks, 3 years, or 30 years, the model will lag in the early stages of that, but eventually it would turn profitable with the trend. Is it possible that the stock market has now found a bottom in February of 2016? Of course it's possible, and we're very, very open to that outcome. However, having done this for over 20 years and have lived through numerous corrections and 2 devastating bear markets, I can tell you that the number of bottoms that are called during those periods, we would probably need an advanced adding machine to keep track of them. We just went out and Googled, took about 2 seconds, found this story published on CBS Market Watch at the time, I believe. It's not CBS Market Watch anymore. It's just Market Watch, owned by Dow Jones. On April 18th, 2008, 5 signs the stock market has bottomed. This is the S&P 500 on April 18th, 2008. You can see we closed at 1390. What happened after the bottom was in? Despite the 5 signs that the stock market had bottomed, the article was published here. Unfortunately, the S&P 500 dropped an additional 52% from the day of publication to the intraday low in March of 2009. One of the most difficult things with markets is it's very, very difficult to discern between a bottom in a counter trend rally and a bottom that will start a new trend. Therefore, if this period here was a bottom, and if we've made a bottom on February 12th, 2016, we don't really need to know that in advance, because if this was a true bottom, the observable evidence would have continued to improve and the model would be able to see that. The same thing applies to the present day. If a bottom is in, eventually the math and the trends and the ratios will start to improve in such a way, and by rule, we will be forced to start adding back to the growth side of the portfolio. Here's another anecdotal case here. This is from Google News from USA Today, dated October 18, 2008. Signs grow that stock market may have hit bottom. And it should be emphasized that some of these bottoms are tradable bottoms, and all of that depends on your time frame. So if someone on Twitter is saying we've hit a bottom, it may be 100% accurate relative to their time frame. Time frames matter. A trader can buy when an investor does nothing, and both may be 100% justified and 100% accurate and correct on their time frame. What happened after the USA Today published Signs Grow that stock market may have hit bottom on October 18th, 2008? The answer? Stocks lost an additional 29% after the date of publication. The article was published here. We did bounce around for a while and then ended up losing an additional 29%. Since there's no magical time frame, magical indicator, magical moving average, or magical risk-on, risk-off ratio, the CCM market model is highly diversified. There are a lot of things that are helpful from a probability perspective. We're looking at a weekly chart of the NASDAQ. We'll use a common weekly moving average from the field of technical analysis, the 22-week moving average. It is used in the model. It doesn't carry a particularly heavy weight. You can see here the 22-week moving average rolls over, the slope rolls over early in the year 2000. We're looking at the NASDAQ weekly. Here, price makes a discernible lower high relative to this high. At 0.3, we make a discernible weekly lower low on a closing basis. This low here is lower than this low here. We try to rally for a week and go sideways, and then at 0.4, we make a lower low. Notice here, too, we stay in oversold territory from a momentum perspective on a weekly basis, and also the bounces that we get are relatively tepid on Williams percent R here and here. What happened next? The answer is, from the point we were just examining here, right at point A, the NASDAQ weekly, or the NASDAQ, lost an additional 38% from point A to the bear market bottom. All of this speaks to trends and probabilities. Notice, for the most part, during this downtrend, we don't get a lot of positive momentum pops. For the most part, we stay in the lower half of this channel here between -50 and -80. So this is the before, slope rolls over, lower high, lower low, and another weekly lower low, weak momentum. Let's compare the look of this chart to the same exact chart with the same indicators and the same moving average in 2016. We'll start in the year 2014. Notice during the uptrend here, for the most part, the slope of the 22-week is indicative of a bullish trend. Here in July, August of 2015, the 22-week rolls over, and then notice after that we make a lower high. Then here we make a discernible lower low. Instead of moving sideways, we actually had a strong up week here. We stayed below this level here. What once acted as support may now act as resistance. And then similar to what happened in the 2000-2001 case, we've gone on to print 2 weekly lower lows now in the NASDAQ. This was intraday on Friday. We actually closed a little higher than this. We closed right in this area here, and similar to the graph in 2000, 2001, at the close, I checked this, we still are in oversold territory. Oversold is not bullish. When it gets bullish is when you leave oversold territory, and more importantly, if you can clear the center line here, then the probability of good things happening increases. Right now, this chart looks troublesome from a probability perspective. Could we see a counter trend rally in this direction? Absolutely, positively, yes. Could we make a bottom here and form a new uptrend? Absolutely, positively, yes. But all of this evidence here looks like a downtrend, and we won't anticipate it under our system. We'll wait to see the evidence improve. Before we go through the rest of the video, you may notice that some of the charts were printed during the day on Friday, and you could make the case that you're missing gains. Well, not really, because all of the charts in this video were published after 11:30 a.m. on Friday, February 12th. This is an intraday chart of Friday's session. You can see the stock market, the S&P 500, basically moved from 1860 at 11:30 in the morning, about 4 or 5 points higher at the close. So we have no real significant change between the intraday charts earlier in the day and the close. If something did materially change, we would have published closing charts in this video. Before we get to the longer term charts, let's just cover a few pieces of anecdotal evidence. This is the triple Qs, or technology stocks. This is 2014 here. What once acted as resistance may now act as support. What once acted as support may now act as resistance. And the term may is in there because all resistance is possible resistance. You can blow right through it. And all support is possible support because you can blow right through it. Point of the exercise. This is intraday on Friday. Here's where we closed. We closed at 98.02. So we closed inside of this band of potential resistance. And we also closed probably right on the trend line that we drew earlier in the day. This is as of 10:56 a.m. Point of the exercise here, the odds for the triple Qs will improve if you can get into this area here. Something that we're very open to. We just prefer to see it, and we're acknowledging that there's still some hurdles to clear. Same concepts here. You can see possible support is possible support because you can blow right through it, as we've done in calendar year 2016. Now these areas could act as possible resistance. This is during the day on Friday. XLF closed basically right here on the line that we showed on Twitter intraday. Similar to the last chart, the probabilities of good things happening improve if XLF can get to this side of the red and blue lines. Have we seen anything that's encouraging? Yes, here's something that's encouraging. Energy stocks here on a closing basis, it's possible that they've now made a higher low. Why is it possible? Well, we don't know what's going to happen next. If we move in this direction, then this was going to be in the short run a higher low relative to this low, but we really don't know what's going to happen next. And all of the things that we said about the previous charts applies. A lot of hurdles here, and we'll learn something either way. We clearly are in a downtrend. The last thing that this chart did was make a new lower low. In this week's video, for the most part, we're going to use the faster duration moving averages. Why? Because if the faster duration moving averages haven't changed, then the longer duration moving averages haven't changed either. We'll start this week with a risk on, risk off ratio. The market model tracks some of the charts that we're going to show. Some of them it does not track, but the principles are going to be the same. Common sense tells us that when we're confident about future economic outcomes, or if we're confident stocks will go up, we'll probably prefer to be in growth-oriented stocks relative to defensive bonds. Conversely, when we're pessimistic about valuations, future economic outcomes, whatever the case may be, we would probably prefer to be in defensive bonds, risk on versus risk off. Here's the ratio here. This is what a risk off period looks like, or a period where we prefer to have our capital out of harm's way. The ratio is below both moving averages. Blue is below red, and the slopes of both are down. We call this a full bore bearish look. It simply speaks to probabilities. A full bore bullish look, you can see when people started becoming more confident in March of 2009, we went from this type of look to a radically different look. Now price is above both moving averages. Blue is above red, and the slopes of both are up. We can see this. It occurs in March of 2009, telling us that the probability of good things happening is higher. Typically, if you have strong conviction, this type of ratio will flip from a look like this to a look like this when that conviction flips from bearish to bullish. How does the exact same ratio look in February 2016? It's pretty easy to see that the probability look of this chart is more similar to the left side, or a risk-off period, than the right side, or risk-on, in the spring of 2009. This chart doesn't tell us anything about what's going to happen in the next few weeks. It just tells us that the current profile remains unfavorable. We are happy to shift our stance if this chart here morphs into something that looks more like this, which is absolutely, positively a realistic outcome at any time, and that's why we maintain maximum flexibility and open-mindedness. Same exact concepts, weekly charts with weekly moving averages, NASDAQ technology stocks. This is 2002, low probability period. Bad things happened in late 2002 and early 2003. If you know your market history, stocks bottomed in 2002, but the bull market, from a probability perspective and risk-reward perspective, really starts in March of 2003, and we can see that observable improvement here, and the model can measure it, and we can allocate by using that hard data. The 2016 version, as of 2 p.m. roughly on Friday, February 12th, full bore bearish look. Each period in history has its own unique set of fundamentals, but the math can handle them all, and the math really doesn't care what the fundamental positives or negatives are. The math helps us track the net aggregate interpretation of all of the positives relative to all of the negatives. When that outcome is positive, markets tend to go up. When it flips somewhat mixed, they tend to go sideways. And when the net aggregate opinion or interpretation flips to the bearish end of the spectrum, markets and market prices tend to fall. Full bore bearish look here in 1987, bad things happened. If you know your market history, in 1998, there was a horrible correction in that period. Very early in the bounce, we can see observable improvement. I can see prices above both moving averages. Blue is above red, and the slopes of both are up, telling us that the probability of good things happening is better here, and indeed, good things happened. The 2016 version, as of Friday, February 12th, full bore bearish look. We should also note when we get discernible lower lows on a closing basis, that also speaks to probabilities, just as discernible higher highs speak to probabilities from a bullish perspective. In the present day here, we have two weekly closes below the weekly close in August of 2015, and we have a full bore bearish look. You can probably name any moving average, simple or exponential, on a daily, weekly, or monthly time frame, or any permutation and combination that makes any sense. And we've probably back-tested it for the CCM market model. None of them are magical. A lot of them are helpful. Some of them are actually harmful from a probability perspective. These are just some of the weekly moving averages that are used in the model. In this case, I believe, if I remember correctly, the questions that are being asked are simple. Is blue above these other weekly moving averages? You can see the concepts are the same. The probability of good things happening is higher here early in 2007 when blue, the fastest moving average, is on top. And then here late in 2007, blue moves to the bottom and the slopes of all of them are down, telling us that the probabilities here late in 2007 have deteriorated. Conversely, in 2009, we didn't have to anticipate or call the bottom or pick the bottom. These are longer duration moving averages, and eventually they even catch up and tell us in the early summer of 2009 or midsummer that things are improving and that the probability of good things happening is higher. How does the exact same chart with the exact same weekly moving averages look in 2016? Remember, we showed earlier in the video that the vast majority of the gains on Friday, February 12th were made by 11:30 in the morning. This is as of 1:34 p.m. and at that point, this chart, the weekly chart, that S&P 500 was still down for the week. It's very, very difficult to look at this chart and say that the probabilities have improved over the last 5 trading sessions. The MAs, blue, discernible lower high, and now a discernible lower low. Even the moving averages on a weekly basis appear to be in a downtrend. Here's an example of kind of a whipsaw look here. If you're asking questions about these same moving averages in the year 2000, the answers start to move from yes to no here, and then we rally telling us that no input is infallible. They all speak to probabilities, and none of them give good signals 100% of the time. Same weekly moving averages that we just looked at. .com peak, blue on the top. Before we peak in the spring and late fall. This is really where the disasters start here in September, if you remember your market history. Now we get blue below. The probabilities not too good here in the year 2000. Did it help on the other side after the dot-com bubble burst? Yes, you can see we start to get the moving averages coming together, and eventually blue gets back above. We get this tight look here and then a big move after that. Again, nothing magical about these moving averages, but they can help us understand risk versus reward based on the market's current profile. Therefore, it's pretty easy to see that the present day looks a lot more like this unfavorable period from a risk-reward perspective than this improving and more favorable period here in the year 2003. And of course, stocks, for the most part, rallied into October of 2007 after this point here. This is the beginning of a new bull turn. No matter what the fundamental factors are, there are several things in markets that pretty much hold true in all cycles. Here's one of them. This is JNK, or an ETF. It's a collection of higher yielding bonds. Notice the yield on it. It's paying what appears to be a very attractive 6.77% annually if you hold it. Now let's compare that to TLT. TLT is only yielding 2.48%. So let's go back to JNK. If we knew with 100% certainty that the bonds held by this ETF were not going to default in the next 12 months, and we were looking for yield in the next 12 months, we would prefer to own this over TLT. Why? We would make more money. This 6.77% is telling you that the risk of default by the companies held, the bonds held in JNK, is quite a bit higher than the risk of default from the U.S. government. Therefore, common sense tells us that when the risk of default or economic outcomes become more uncertain or unsettled, that the ratio of junk bonds to defensive treasuries falls because investors would prefer to own the lower yielding and safer treasury bond. Conversely, when the economy starts to improve and people are confident, so assume there's 100% certainty that your junk bond is not going to default, you'd rather own it, and the conviction to own it is therefore higher. So these slopes tell us something about the perception of defaults and future economic outcomes. The same ratio in the year 2016 continues to have a look of economic fear. This looks a lot more similar to this period here than it does this period here. JNK, or junk bonds, underperformed more conservative and defensive-oriented treasuries by 3% over the last 5 trading sessions, and that includes the differential on Friday. This is as of the close, 4 p.m. on Friday, February 12th. If this ratio here starts to morph into something like this, then we would be more open to allocating our assets to the growth side of the portfolio. The same exact concepts apply here, risk on versus risk off, S&P 500 weekly relative to those defensive-oriented treasuries. This slope looks like fear. This slope looks like improving economic confidence, 2016. If you go check this ratio as of the close at 4 o'clock, this number actually got worse. The closing number was a loss of 2.91% at 4 p.m., telling us if you came into the week owning the S&P 500 index relative to somebody that owned TLT, TLT outperformed at 4 p.m. on Friday by almost a full 3%. This is not a look that tells us we want to put our capital in harm's way based on our time frame. We are always open to improvement. As we have mentioned numerous times, ugly charts, including every single chart that we've discussed in this video, can begin to improve at any time. Examples: if you looked at charts in the second half of 2002 and early 2003, they did not look particularly good. If you looked at charts in late 2008 and early 2009, they did not look particularly good. If you looked at charts on October 1st, 2011, they looked horrible. In each case, the charts began to improve, and after that improvement, stocks rallied significantly, and they rallied significantly for a long period of time, telling us that we need to maintain that maximum flexibility. Our goal is to stay aligned with the market's current profile. Our goal is not to try to forecast what is, for the most part, an unforecastable and uncertain future. Therefore, if we pay attention to the observable evidence, the risk-on, risk-off ratios, the models, and continue to follow the rules, it really doesn't matter if the trend is down or up. And as we proved in 2015, the difficult part is not an uptrend or a downtrend, it's those indecisive periods. Right now, we're in a decisive period. It's a downtrend. How long will that last? We have absolutely, positively no idea, and we don't need to know if we maintain the proper flexibility heading in to next week. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The sub-models, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The sub-models allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.